want to get to our next guest. He is Chris Kotowski. He is one of the top-ranked analysts covering Wells Fargo, according to data compiled by Bloomberg. And Chris, you nailed it on the head because you said it really is more than just about the bottom line or the top line for this bank. It's about their loan portfolio and non-performing loans up to $3.5 billion. A big concern for you.
Well, there are no surprises really thus far, and what we track is the rate at which problem loans are flowing into the banking system. And in the third quarter thus far, it's almost identical to the rate at which problem assets were flowing in the second quarter. So, there's no discontinuity. There is credit deterioration, but it's been on the same rate and pace as it was in the second quarter.
So things are not getting worse, but they're not getting any better either.
People shouldn't have expected anything different from this. This is roughly what we expected, and it's roughly what we modeled. And it's funny, I was just looking at the Wells Fargo number, non-performers going up to, I think it's 23.5 billion. We were modeling 23.4 or something like that. So it's very close.
So you were pretty close.
We were pretty close. And I do think we need to throw out the bottom line EPS number for this year. It tends not to mean very much. What we really need to focus on is the pre-provision earnings line and the net charge-offs. Those are the two real lines of the income statement. If you think about it as an analogy to the cable companies, it would be like EBITDA and interest expense.
Chris, I just want to jump in. It's John Erlichman. On the mortgage side of the business, mortgage originations, they were down from the second quarter. Maybe no surprise because refi activity is not as hot as it was. But does that concern you, coupled with the non-performing loans rising?
No, again, the non-performing is rising. It was same as everybody else, and exactly the same as the prior quarter. And we really didn't expect that to peak until the fourth quarter. Mortgage originations, the second quarter was a record quarter, and we were modeling it for it to decline. So that's all as expected.
Chris, you were mentioning net charge-offs before, and the losses Wells Fargo saying on that is still increasing. They noted that it is as a percentage of average loans at 1.34% and is at $5.1 billion. What does that tell you overall, though, about the health of the bank then?
Well, with Wells Fargo, if you look at their pre-provision earnings, it's more than twice the level of charge-offs. Meaning, for every dollar of losses they're taking, they're still adding a dollar to their capital base every single quarter. Compare that to Bank of America, where the coverage ratio is 1.3 to 1. At Citibank, it's about 0.8 or 0.9 to 1. At most of the regionals, it's less than 1 to 1. So Wells Fargo is really powering through this compared to most other banks. Again, for every dollar of charge-offs, they have $2 in earnings. So they're building capital quarter in, quarter out. And it's just a much stronger company than most of the other ones out there.
Okay, but the stock is still selling off, though, Chris. I mean, just very quickly to wrap it up, what are you going to look for then in this quarter, in this current quarter that we're in for Wells?
Well, okay, the stock is selling off, though Goldman Sachs also sold off right after it reported great numbers. So, take that with a grain of salt. Mm-hmm. For this coming up quarter, again, what I'm looking for generally is relatively stable pre-provision earnings, and then the companies will plow some amount of that into reserves. And I would expect fourth quarter generally to be kind of a cleanup quarter.
Okay.
If ever there was a reason to just be aggressive and throw everything you can into the loan loss reserve, this would be the one.
Okay, Chris, good to talk with you. Thank you so much for joining us on the Reaction to Wells. Chris Kotowski.